Hey everybody, welcome to another Wealth Wednesday webinar. You got Brian Fouch here as your host with Craig, our host, and Mike Samet as our host this day. Today we're going to be talking about the vault. So Craig is going to be going into some aspects of the vault. I think you're going to do some case studies. Is that correct?
Yeah, we can go through some case studies, and I think what might be good is just to go through initially, just kind of maybe, I don't know if you want to run through what is infinite banking.
We are.
We can
Yes.
chat about that, and then we can get through some different use cases here in the vault.
Yep. So I'm going to go through a quick rundown of infinite banking, sort of the aspects of it, how it functions, and obviously some parts of the mindset around it. And then we're going to get into the sheets. So I should say that Frank said between the sheets and
Get
dive
into
on
the
into that.
sheets.
Now, before I get into that, a couple quick things for some of you that might be new to BYOB or Wealth Wednesday webinar. We do have about 6 live stream events we do a week. Wednesday is the heavy day. We got WTF in the mornings. We've got Wealth Wednesday here right now. And then we've got the Ask Me Anything at 4:30 Eastern, live stream through YouTube and also on Facebook. Let's see, Take Back Control Tuesday as well on Infinite Banking on Tuesdays. And then we have our Wealth Mondays as well. And then am I missing one? There's so many events I forget sometimes.
Yeah, there's always a lot of them.
Yeah. And then also, for those of you who are not aware, we do have our 3-day virtual event, the BYOB Blueprint, coming up this Friday, Saturday, and Sunday. I'm going to put a link in the chat box for you guys as well because that event is going to be awesome. We've got speakers coming in on all different topics around investing, real estate, infinite banking, estate planning, asset protection, and much, much more. So definitely recommend you check that out. I think I actually had the link right here. I'll put it in the chat box right now. But that event is going to be a great one to attend, just from a knowledge perspective, just for meeting a lot of different advisors and learning about different strategies. Definitely recommend that. I'm going to put that in the chat right now, so you guys are aware of that. Go check it out. If you choose like the $97 version, it's you get all the recordings. So I definitely recommend doing that version so you can get those sent over to you as well. All right, so let's kind of dive into kind of what infinite banking is. So I'm going to bring up some slides here. You guys may have seen these before because they are part of our general presentations. So when it comes to infinite banking, one of the things I always ask before we kind of get into this is when you look at building wealth or investing, that kind of stuff, or even money, or just changing your situation, there's kind of three things I look at that we should want to control around this. And this is going to play into what I'm going to be talking about and then what Craig and Mike are going to be talking about as well. So the first kind of question I always ask everybody is, what in life should you control or want to control? Now, the first thing that most people will say, of course, is going to be money. And money is definitely something that we do want to control in life because that is just a tool. It's just a tool. And once money goes, it can come back and forth. You can make money, you can lose money, all that kind of stuff. But it is one of those things that is a tool that just allows us to do other things. Now, for me, the one thing that I want to control above all else is my time. So I prefer time beyond anything else in my life that I want to control. And that's the one thing that once it goes, it never comes back. So obviously, controlling money can allow you to control time. But the one thing above both of those you got to control first, which is a big thing that we talk about here at BYOB and Money School, is your mind. You've got to really control your mindset around money because as you go through life, what happens, unfortunately, is that we are programmed. So when people hear about infinite banking and, hey, I can become my own bank, I can control my money, oftentimes they don't really quite understand what is going on. It doesn't make sense because it's against what we've been programmed or taught around money. So as we go through this Wealth Wednesday webinar and our 3-day, we always are challenging mindset just because a lot of us, when we look at this, it doesn't jive with what we've been taught or told to do with our money by the powers that be, so to speak. So I don't know if Craig, if you guys have any comments on that, but the mindset is one of the big ones we run into a lot, I think.
Yeah,
Okay.
I'd agree, Brian. I mean, the mindset is a big thing because we've all been told a certain thing to do over time. Call that the traditional planning of how finances should work. And I read something the other day. I said, if that system works so well, why isn't it working for everybody? So,
Yeah. Yeah. Like how many people do you know that have retired 100% off of a 401k? I've
yeah,
met one or two people. That's about it.
Hmm.
Maybe one or two, but definitely not the millions that are using it or funding
yeah,
it right now.
yeah.
You
Yeah.
know,
Less than 5% of the people can retire comfortably. In the wealthiest nation in history, something's wrong.
yeah, it makes no sense. What 5% of people that retire can retire with some financial security. That doesn't seem to make a lot of sense, as Mike, you said, in this country, it doesn't make a lot of sense. But that's where we're at. So let's kind of talk through kind of how infinite banking and what it can do for you real quick. And because when we look at other strategies, we want to say, okay, what's this going to do for me? What's going to help me accomplish? So with infinite banking, one of the first things that it does right off the bat, day one, not year 40, but day one, is that it creates guaranteed tax-free, by the way, generational wealth immediately. So right off the bat, you have that guarantee locked in. It allows your money to grow uninterrupted and compounded for the rest of your life. And by the way, with guarantees. Now, I'm not aware of any other or really any other strategy that does that. This is one of the few ones that does allow your money to grow uninterrupted for the rest of your life. And then, as we always talk about control, we want to control money. So, infinite banking, what it does is takes control of your money away from corporate America, big banks, Wall Street, and puts that control into your hands. If you want to build wealth, you want to have more of that, financial freedom in your life, you've got to be in the driver's seat. And what I mean by that, and this is an analogy that I'm starting to use, and I like this one, is that too many people, when they approach finances or investing, they go to a traditional financial planner and then they get onto a bus and they go sit in the back, and then that person takes the driver's seat and then starts driving, but you're in the back. You're not in control of where you're going. You're putting fuel in the tank. That's your money, by the way, but you're not in control. With infinite banking, you're the one in the driver's seat, which is a big part of, hey, I want to have more wealth. You got to be in the driver's seat. It does protect your money. So if you're going to make money, you want to keep as much of it as possible. So this protects it from lawsuits, from bankruptcies, divorce, creditors, court orders in most states, by the way, that is state specific. So for some of you in some states, sorry. And then, but of course, the big thing about infinite banking is it allows you to be the bank for things that you may normally use a bank for. So think of things like real estate investing, buying cars, college, weddings, retirements, investments, of course, all that. But you're doing all these things at the same time. So that's a big difference from other strategies. With real estate, your money is in the property. That's it. It's not somewhere else working for you. With this, you've got more things going on at the same time. I call it layered benefits. That's a big part of what infinite banking does and why it's a bit different. So that is why we love it. Now, the next thing I want to share real quick is sort of what is infinite banking, what makes it function. So infinite banking, what I want you to think about is think about infinite banking like a car. So a car has seats, seat belts, hopefully. It's got wheels, brakes, tires, radios, all that kind of stuff. That's the infinite banking concept. Think of it like a car. But for that car to go down the road, what does it have to have? It needs to have an engine. So infinite banking can use different types of engines, but there is the most efficient engine that exists. And for us, that is a permanent dividend paying whole life insurance policy, specially designed for infinite banking from a mutual insurance company. That's the best thing that allows this infinite banking car to go down the road. Now, we do get challenged quite a bit. Well, why a life insurance policy? Why not, a 401k loan, which does work, by the way, kind of. Why not IULs or VULs or other types of things? Well, if you want to understand the answer to that question, think about who is the biggest buyer of infinite banking structure policies in the world. Well, in the US and Canada mainly. So it's banks. So big banks, your traditional banks that you see, they're buying more infinite banking policy, structured policies than they do their real estate, buildings combined, all that kind of stuff. So if they're buying it through whole life insurance policies, why would we do something different? If all the big wealthy families are doing infinite banking through whole life policies and been doing it for over 130 years, why would we do something different? Well, we don't. So that's the vehicle that allows infinite banking to exist. So anybody want to add anything on that one, Craig or Mike?
Bank of America is up to over 25 billion, I'm sorry, with a B.
Wow, where'd you hear that from? They have to disclose that?
Yeah, that's just out there.
Wow. That's climbing too. I've heard that most of the banks have quadrupled the amount of holdings they have in life insurance since 2016.
Yeah, it's their
So
safe tier one capital. And banks aren't stupid with their money. So
nope, they are not. So yeah, so they are just buying more and more of this. So that's the best, vehicle we look at for when it comes to infinite banking. Now, what I'm going to show you real quick is just how an infinite banking policy, just numbers wise, just real quick functions, and then we'll get into some of the kind of the more of the mindset stuff around it, and then we'll get into the vault. All right, so let's kind of look really quickly at what the numbers are kind of on a policy. When it comes to like funding a policy or having infinite banking in place, what we're doing is we're going to be funding a dividend paying whole life policy. Now, the first way that we do that is with what is called a premium deposit. Now, why do I say deposit and not like a premium expense or premium invoice? When you have car insurance or health insurance or all those kind of other insurances, they call them, there's always this invoice you've got to pay, but you're not really getting any benefit out of that unless something bad happens. Get sick, get in a car accident, house burns down. With infinite banking, as soon as you put in a premium deposit, you have immediate benefits, meaning that you get cash value that you can borrow out right off the bat. So in this on the screen here, what you can see is I have someone putting in a $10,000 deposit for $10,000 per year for the first 7 years. Now, what you're going to see, and by the way, that's just their numbers. Your numbers are your numbers. It can be more or less depending on your situation. This is just an example. Now, what you'll see over here is this cash value column. Now, what you're going to see is every deposit that goes in, that cash value goes up. But if you look at this, you'll notice that it's growing greater and greater every year. That's because of dividends. So these are dividend paying policies. Dividends go into your cash value and you earn those no matter what. So in this example, this person puts in $70,000 for 7 years, but look at the cash value. Just keeps on going up. 71,000, 74, 77, 80,000, 84, just keeps on going up. That's dividends, and that is the uninterrupted compounding. So the other thing I'll mention inside here that we don't focus on a lot is the age. Age is a factor, but once again, we're focusing on the living benefits, not the death benefits, by the way. We focus on the living benefits, which is the cash value that you can use. So there you go. Now, the death benefit is a benefit, but it's just not the one that we focus on. All right, now the last thing I'm going to show here real quick, this is actually that illustration. I'm just showing it to you here, right, with the actual tabular detail to show you this is a real illustration. These are real numbers with a real insurance company that we're talking about. But yeah, as you can see, this thing, it just keeps on growing year over year over year. And whomever has this policy can use that cash value for whatever they want without impacting the growth. So that is, generally speaking, how infinite banking policies function and what they are. Now, the last thing I'm going to cover real quick before Craig takes it on is what is the thing that can make infinite banking fail or make it not work? That's a question I get quite a bit. Or, what's the risk associated with it? Well, it's kind of two things. Mainly, it's going to be with you, the policy holder, because you're the one that's in the driver's seat. Now, the first thing I will mention, though, is making sure that you do have a properly structured policy with a good company that is structured for you specifically. Now, how do you do that? We've got to work with the right people, people that have the right experience, the right licenses, the right training. That's us, by the way, tooting our own horns, of course, but we feel that we are some of the best that do this. But yeah, so working with somebody who understands and uses infinite banking in their own lives is paramount. So if your financial advisor does not do infinite banking, do not have him set up your policy. That would not be a very good idea, right? So making sure that that person does have it set up and does use it. That's one of the key things that I focus on. But the second, the main thing though is the person, because you're the one in control of your own policy. So if you misuse it, then it might not perform very well because, hey, I'm not paying back the loans as an example. Not a good idea. But the first place to start though is inside your mindset. So if you don't have the right money habits, the right money mindset, and the right skills around money, infinite banking is not going to solve that for you. You've got to make sure that you have some financial literacy and responsibility to make infinite banking function. And that's a big thing that we talk about when we're talking with clients. It's also why we're doing these kinds of webinars every single week to give our financial knowledge to you or whomever we have come in and speak to share our information. That's a big part of it. And then being around what we call our campfire. Our campfire is just attending our live events, attending our virtual events, and just being a part of our group. And then we got a lot of people inside the chat here, by the way, that have been around for quite some time, and they're still here, of course, because they're still learning. Now, the last thing I'm going to mention real quick is something around the kind of the money mindset side of things, because I used to do this as part of one of my businesses is teach this kind of stuff because if you have limiting beliefs around money, you've got to change those limiting beliefs, or some people call it overriding limiting beliefs. So I'm going to share my screen here one more time and go through this topic because this is one that I used to teach quite a bit, and I learned some of this from Bob Proctor in one of his advanced programs, which are really good, by the way. So, kind of 3 simple steps to changing your beliefs today. Because if you have limiting beliefs around money, you want to start addressing those kind of things. So one of the first ways to do it is one is just to start out your day just being grateful. It's a weird thing to say, but if you don't do that, it's your mind can go into negative places. But for me, this is one of the first things I always do is just start with a positive mindset, just being grateful. But here's really how to start changing your beliefs. So for me, identify one limiting belief that you know is holding you back. Okay, just find out some belief. Maybe it's, hey, the rich get richer, as an example, right? Or you have to have money to make money, or some sort of belief around money, right? I have to work harder to have more money in my life, whatever that is. And so what I had my students do is they would write this down on paper, okay? And write down the actions around that belief that you take, the habits around it that you have, write down as much as you can around that limiting belief. And then what I would do is I'd write down the opposite beliefs on a separate piece of paper. So what's the opposite of that one? Then take the negative one and burn it. Actually, literally go outside and burn that one and then keep the positive one. The reason why is that when doing that physical action, it has a lot more impact than if you just think about it or just write it down. The act of burning something for some reason, for some people, is very powerful. So that's a good one right there. So just do that and then just focus on the opposite beliefs. And your subconscious, which is where your beliefs are, is very powerful, but your subconscious is not good or bad. It's just you get to choose. But that's just a kind of a quick little exercise. If you have some sort of belief that you think would serve you being changed, that's a good way to do it. So yeah, so that's just something that I want to share with everybody there because of the having a good mindset around money and good money habits is definitely going to help you when you're using infinite banking to have it be more successful, have it be more consistent, and actually be faster for you. So there you go. So with that, and then the other thing too, I'm going to mention real quick that to have infinite banking be a more successful strategy for you is having the right tools as well. This is something that Craig, Mike, and I have experienced a lot, and it's unfortunate where somebody will have an infinite banking structure policy, somebody else set it up, they come to us and say, I have no idea what I have or how to use it because they have no tools because the agent that set that up for them maybe doesn't know how to use infinite banking, doesn't have any tools, and doesn't have the time or the team to teach that person how to use infinite banking. So we've all experienced this in our own journeys. And because of that, we have created tools and resources to help ourselves to be more successful with infinite banking. And now we use those same tools and resources for you so that you can have that same success. And then the vault, which is what Craig is going to share here, the vault has taken a lot of the strategies, the knowledge, and the tools that we have and put into your hands. So once again, control is a big thing about it. And so the vault can really help you control infinite banking and your money a lot better. So with Craig, you want to go ahead and take it away?
So one of the things that I want to kind of share with everyone, so Brian kind of set up infinite banking, what it's about. We do use a specially designed whole life policy to solve the problems that we're working towards in infinite banking. And before I jump into the software, I just want to talk a little bit about what are some of those things that people want to do with infinite banking. So the whole title infinite banking means there's an infinite number of possibilities we could use these policies for. The banks use them for storing capital. You could use it for legacy. You could use it for debts. You could use it for buying major purchases. But Mike and Brian, what are some things that you've been hearing recently from clients? Like what are people trying to do with their policies?
Paying off debt is the number one thing.
Yeah, I mean, that is obviously one of the big things. Investing is one of the desires they want to do with it. It doesn't always happen right off the bat because there's I always look at the two steps of building wealth, right? First step is get rid of bad debt. Second step is put good debt to work or put your money to work. Most people are on step one. So the step two is the second goal, but we got to take care of the first one. And then I would say playing catching up, like feeling that we're behind. Hey, I'm 50, I'm 60, I'm 65, but I haven't really felt like I've saved anything. I feel like I'm kind of behind the eight ball. And so people are coming in saying, hey, I could do a 401k, but that's not going to catch me up. So they're doing infinite banking because you can overfund the thing and get it going really fast. So a lot of people playing catch up like that, I've noticed.
Yeah, and I'd say with Mike, I'm kind of with you as well. A lot of people coming to us with debt. Of course, we have the investors looking for ways of putting their money to work in multiple places. So there's lots of different use cases out there. And a lot of times that comes down to before we start designing around that system, we want to know what you're specifically after. And so when we talk about debt, I'm not surprised. We have a lot of folks in there saying they have debt. And this is a slide I think I pulled from, was it Q3? Yeah, Q3 of 2025. So there's probably an updated one. But it's interesting to see that household debt hit 18.59 trillion in the third quarter. And yeah, and so Loran, the US debt clock is a good one to look at as well. But when we start peeling down what is this 18.59 trillion of debt, credit card balances rose by 24 billion and they're currently at 1.23 trillion. Auto loan balances holding steady at 1.66 trillion, student loans at 1.65. So I put this in this next chart just to kind of give a visual of mortgage debt to auto loans to student loans to credit cards. Now, the one thing that kind of jumped out in Brian and Mike, I don't know if it jumps out to you as well, but what number on here would you like to see higher of all these on the chart?
Depends what the other debt is. The other debt, 550 billion, seems like a fairly large number to be other.
Yeah,
But it's weird seeing 13 trillion, 1 trillion, 1 trillion, 1 trillion, and then home equity is only 400. But the home equity is the only one in here that is actually a real tool that can be used to build wealth.
yeah, and that's exactly what I picked up on too, Brian. I looked at that, I'm like 422 billion. So if you're familiar with velocity banking and infinite banking, and I'm going to show you this in the vault, those two things can work together very well. And in the right situation, if we could use a tool like a HELOC to help get rid of these other bad debts, that might be a way that we put some focus on getting rid of these credit cards and student loans. And also found it pretty interesting that auto loans and student loans are neck and neck, with 1.6 to 1.65 trillion. I just thought that was interesting. Everybody needs a car. I guess everybody needs a student loan debt too.
Yeah.
So anyway, so we'll kind of touch on velocity banking, but I was surprised by the 422 versus the bigger numbers that we saw up above. Now, before I move into the vault, I do want to just talk about one more thing here because we just looked at the debt situation, but then we also have the savings rate of disposable income. And I can make this bigger so we can see a little better. What's interesting is when you look at the savings rate over time, so right around February of 2020, June of 2020, we had this huge spike, which we all remember is COVID. Stimulus checks are coming out. People didn't have anywhere to go to spend it. So a lot of money ended up in savings accounts. So our savings rates went way up to over 30%. But traditionally, since we came off of that, savings rates have been in the 4 to 5% range, under 5%. So if you think about these two things, think about these two forces where there's a huge amount of debt and there's very little savings going on. That's what I call the triple threat because we have increasing debt, decreasing savings, and the place where we're putting that savings. Now, I know there's some out there probably saying, well, wait a minute, Craig, I've got one of those high yield savings accounts. I'm making 3.5%. Well, and maybe 4 or 5 months ago, maybe it was 4%, but we're starting to see those kind of come back down. It's not something that you're guaranteed for the next 10 years, but I did look at the average savings account rate over a long stretch of time, and it's about 0.42%. So aren't those banks generous? Just so generous that they give us 0.42%.
And
Now
that's
you have to pay,
taxable, isn't it, Craig?
yeah, and you have to pay taxes on that 0.42%.
And is the compounding uninterrupted?
Yeah, so you take the money out, I'm not earning that 0.42
Yeah.
anymore. So that's a problem too. So those inefficient savings storage is what we're talking about, where we're getting low rates, we're interrupting the compounding. Anyway, when you get into the vault, there's a couple of different resources. Brian talked about mindset, and we're programmed early on to do money a certain way. And if you think about that programming, who is that programming serving, right? So the way we do money, is that in our best interest or is it the best interest of the banks? Who's it in the best interest of? I would take the approach that the banks are not looking out for us necessarily. I think the banks are looking out for themselves because, of course, they're in business to be a bank. So we have to kind of get educated, and I'm glad that you're all here because we, on these wealth webinars, we teach about infinite banking. There's many different things we do throughout the week to teach on infinite banking. But as you get into the vault, there's going to be a couple resources. There's this thing called Chris AI and Christy Van AI. So if you wanted to learn more about infinite banking or you want to learn more about velocity banking, you can come right in here and ask Chris any question. Now, these aren't just web searches of, what would Chris possibly say if I asked how a policy loan works, or, for example, what's the best company to use for IBC? We hear that sometimes. What we're doing is we're taking all of the content that our team creates, that Chris creates, the books, all of that stuff, and it's getting indexed. So when you ask a question such as what company is the best for IBC, well, Chris is going to give an answer that is in line with the way we would teach because it's coming right from our content. Then, if you want to keep asking questions about that, you can, or you can drill into more information where we may take you into a previous wealth webinar or another YouTube video or some other piece of content where we've done some teaching about that specific content. So just know that there's a huge amount of value here as we're starting to learn and starting to understand more about how infinite banking works. You have this at your fingertips. And then Christy Van, one of our valued partners, she teaches velocity banking. Do we have any velocity bankers out there? If you do, just put in VB in the comments. But velocity banking is really a strategy where we're using lines of credit, HELOCs, and it is a tool from the bank, but we're using that tool for our benefit. We're using it to take a simple interest tool and maybe pay off a home mortgage. We're trying to do these different motions and keep our money in motion so we benefit as opposed to the banks benefiting. But same thing that we've done for Chris AI, we've done for Christy Van. So there's a lot of different questions people ask Christy Van. I see it on the YouTube channels, I see it on her content. And so you can come in here and ask questions like, what's an all-in-one? What's this one? Is it better to use my full line of credit or use chunking? And those are some things that I'll talk about in the vault that we've solved some of that math behind the picture for you. So anyway, just know you have those resources out there. Now the next thing I'm going to jump into is just the what we call the policy officer. So if you have a specially designed whole life policy, you have the ability to upload it into the vault, and I'm just going to show you a couple examples here. Brian showed you a policy. I think Brian, you were putting in 10,000 a year into that policy that
For
you shared.
7 years, yeah.
Yeah. So just know that when you come to our team, if you book a call with Brian or Mike or myself or anyone else on our team, we're going to want to understand what it is you're trying to accomplish, and then we're going to build a policy that helps you accomplish that goal. So your policy may look different than somebody else's, but they're all going to be high cash value policies. And what I mean by that, let's just talk about traditional whole life policies. These are the ones that you hear Dave Ramsey talking about or Sue Zorman, that why would you put in $10,000 into a whole life policy and get no cash value? What's wrong with you? And he starts yelling and throwing a fit and telling you need to chase the whole life guy out of your home with a stick. And I don't know if you guys have seen those videos, but I laugh every time I see him because he just gets so animated with this stuff.
Or
It's
calls
just
you stupid.
yeah, and he has a lot of misinformation, and I struggle with that because I don't think Dave means to mislead people, but he's definitely not informed on the reality here. Here's a traditional whole life policy. This is what Dave Ramsey talks about. Let's say you're putting in $10,155 of premium. Cash value, zero at the end of year one. Death benefit, $846,000. Well, what do you think Dave Ramsey's going to say about that? He's going to say, why in the world would you put $10,000 of premium in for a $846,000 death benefit? You can go get a term policy for a fraction of the cost, probably even $1 million. You know what I mean? And he says, and you have no cash value. Why would you ever want one of these? And so after 3 years, you've put in $30,465 and you have a whopping $5,433 of cash value. He's like, why would you do that? And so we tend to agree with Dave. But before I move on, if you have a traditionally designed whole life policy, and let's say you've had it for 15 years, don't just go get rid of it. It's probably at the point where it's getting close to its efficiency stage. You probably have significant cash value built up at that point. But, just if you have a newer one, we might want to look at that and figure out what are some options to maybe get you in a better position. All right, that's traditional. Now let's look at something the way our team would design it. The exact same amount of money, 10,155 going in year one. The first thing I want to point out is remember the death benefit in the traditionally designed whole life policy was 864. I think it was 864. This is only 164,000. So we're definitely squishing down the death benefit so that you can get a cash value immediately within the first 30 days. So would you rather have $10,000 of premium and no cash value, or 30,000 at year three and 28,000? If you're doing infinite banking, this is really the way we have to set this up. We have to squish the death benefit down in order to get the cash value. And that's going to be the biggest difference between what we do and how we build these policies versus traditionally designed whole life policies. So once we get our policies loaded, then we can start to use them. And I'm going to go into a debt, since there were a lot of folks here that had some debts. Let's just talk about how we can be more efficient in our debt strategies. So these may not be your debts, but it could be representative of credit card. You have credit card debts, you might have personal loans, you might have medical debt, car loans, student loans. So really our first step is to go through here and add each one of our debts. We just pop open add debt, put in a name, put in a balance, put in the minimum payment, put in the interest rate that we're paying. Now, if you have one of those 0% introductory rates where maybe you have a credit card that is at 0% for, let's say, 12 months, 16 months, whatever it's going to be, at some point that introductory rate's going to end. And so we want to put that date in, and then we also want to put in what is that rate that it's going to change to, because we want to factor that into our equation. So once you get all of your debts into the system, the first thing we want to talk about is strategies of how we want to attack this debt. So step one is let's figure out get the debts in, and then we're going to put them in an order that is efficient. And what I mean by the order is when I'm done paying this personal credit card and I pay this $2,500 balance off, don't I have $75 in my cash flow now to do something with? What do most people do when they're done paying this personal credit card? What do they do with that $75? Where does it go? Most people just take that money and spend it. And, at the end of the day, if you have really, really, really tight cash flow, maybe you do need to spend that. Maybe the kids need some new clothes. Maybe it's time for back to school. But generally speaking, what we want to do is we want to get that money into the next debt. So we want to put it on to the other debt. Exactly, William. We want to put that into the other debt. So now instead of paying 125 to that business credit card, I'm going to take the 75 and the 125 and make that. And that's known as a snowball, right? So Ben says snowball. There's other strategies out there. Snowball is lowest balance to highest balance in terms of the debt. There's an avalanche strategy, which is highest interest rate to lowest. There's something called the cash flow index, which looks at the balance divided by the payment, comes up with an efficiency score. At the end of the day, we don't really care which one of those to use, but we just want to know mathematically which is the most efficient. So we scroll on down to this payoff strategy. So here's where we need to make our first decision. If you want to continue to do debts the way we've always done them with no strategy, that $78,000 of debt is going to take 181 months to pay it off. And you're going to tack on almost $30,000 of interest. So you're going to pay $108,000 to get rid of that $78,000 of debt, right? So what we're talking about is whether we use the snowball, the avalanche, or the cash flow index, there's a mathematical reason of which one we want to use. And in this case, the avalanche. And sometimes it shows up as a snowball, sometimes it shows up as a cash flow index. But in this example, we're saying the debt avalanche is going to be more efficient just because you're paying a little bit less in interest. Now, Anthony makes a good point where there's math and emotion. And at the end of the day, you might decide, well, I want to do the snowball because I can get rid of some of those lower balance debts and free up some cash faster. It may not get me out of debt faster or save me interest, but at least I feel better about getting some of these debts off my list. I have no problem with that. We're just simply showing you mathematically which one to use. Now, when I'm doing strategy calls, sometimes I meet with folks and I saw somewhere in the comments, someone said, I only have $30. So let's just say you're one of those people where you have some debts and you don't have enough cash flow. Well, what we want to do is work this debt avalanche or snowball until we go down here and we can find when we get some cash flow. We start freeing up some cash flow down in month 30, 31, and everybody's situation is different. I've seen people where if they follow this, they can free up cash flow that's significant in 6 months or 7 months. But now we have a path, right? We have a plan of what to do. But let's say that you have been watching Christy Van. Maybe you saw Chris Naugle on there and you're like, hey, what is this velocity banking and infinite banking thing? So you've been exploring velocity banking. So I want to show you what that looks like with your debts. Let's just say that you've gone through, you've put your income in. So you have some different income sources, such as your Acme Corporation, it's where you work, and then you might have another job that, you do tech solutions. So you've got about $7,293 coming in every month. Then what we do is we go through and we list all of our expenses: termite inspection, state farm insurance, green thumb landscaping, all of these things that we're going to put in for automobile expenses, living expenses. And we also want to list what we call our velocity banking tool. Okay, so what is a velocity banking tool? Mike, Brian, you guys talk to people. What are some velocity banking tools that people use that share with you?
HELOC or a personal PLOC a
Mhm.
lot of times, even a
Lock
business line
business
of
line of
credit.
credit. Chrissy does teach how to use credit cards. I haven't really studied that method, but I know a lot of clients are doing the credit card method. And then the other method is Money Max. So Money Max is a version of that, just using multiple different accounts that have interest rates. And then, of course, cash value life insurance.
Yeah, so a lot of times when you're following Christy Van, she'll talk about all those different strategies. And well, let's just say that you went down to Wells Fargo and you received a HELOC on your property and they gave you a line of credit for 50,000. Maybe use 5,000 for some emergency. So you have 45,000 available still at 7.25%. So the question is, how does this whole thing work? And so what we want to do is go back to our summary and think about with velocity banking, let's just stick with the HELOC example. We're going to take all of our income and we're going to put it into the HELOC. So instead of just keeping the money in our checking account, when we get that money, it's going to go right into that HELOC. Now, any of the expenses that we can pay out of the HELOC, you might have an all-in-one with a sweep checking account. There's all these different configurations. But the idea is if we can pay our expenses out of that HELOC, our income goes in, our utility bills get paid, our Verizon bill gets paid. There may be some things that you can't pay with your HELOC. So we're classifying which expenses can be paid with our HELOC and which ones can't. And then we're also considering all the debts that we have above. And what we're looking for is what is our net cash flow? So by the time we get our income, we pay our bills, we pay our expenses, we pay our debts, what do we have left over at the end of the month? $1,366.33. Okay, so that's now what we call our net cash flow. Now what we're going to do is use this Wells Fargo Velocity banking tool that has $45,000 of available credit. So here's a question for the audience. And Brian and Mike, you can't answer this because I know you already know the answer. All right, audience, you ready for a question? If I have 45,000 available in my HELOC and I have $78,000 of debt, should I use all of that 45,000 to knock down this $78,000 of debt? So should I use all? Should I use some? What do you guys think? Well, I'll tell you what, when we started this project and we were working with Christy and some others that are velocity banking experts in the industry, there were some different rules like, hey, use 2 times your income. There are some different things to think about. And Terry brings up a great point. You want to think about your emergency fund too. That's part of, if your HELOC is part of your emergency fund, then you need to think about that. So here's the thing. There is math behind the scenes. We call it the optimizer. And what it's looking at is your debts, your interest rates, your balances, your income, your expenses, all of these things, all of these ingredients. And it's going through and saying, well, even though you have 45,000 available, we believe mathematically that you should use 26,856 as a chunk size for your velocity banking tool. Now you might say, well, that's great, but I want to use more. So I'm going to drag this thing up to 35. You'll see down here it's saying if you don't use the optimized value, you're going to add $355.74 of interest cost to your entire payoff strategy. Now, why is that? There's a certain point where the HELOC could become more expensive than some of the debts we're paying off. So we're constantly balancing all of that out. And that's why we have this optimized value. Trust the math. That's all I'm saying is trust the math. We figured it out. Now, here's the fun part. Let's activate the velocity banking. So I just clicked on this button to say, I want to use this velocity banking and this chunk to pay off my debt. So as opposed to 80 months, who would like to get rid of their debts in 23 months versus 80 or versus 181? Well, I think everyone's going to raise their hand on that one. So it's going to take a little time to pay off the velocity banking tool. So we're still looking at about 30 months to pay off all of our debts, restore our velocity banking tool. And so at the end of that 30 months, we freed up $1,265 of cash flow. Instead of paying $30,000 in interest, we paid $7,500. So velocity banking is just flat out going to be one of the fastest ways we can get ourselves out of debt. But it does require the discipline. It requires all of that, right? Here's the next step. What happens if we stick with this plan in 30 months? Let's just agree we're all out of debt. We've refilled our HELOC. We do have some line of credit available, but I always look at this and say we're still at risk for getting back into debt. So the next car loan we have to take, the next time we have an emergency or medical debt, we're going to start swiping and we could potentially just be right back into debt again. So what we're going to do now is we're going to take a little bit of our cash flow. What if we took $500 of this cash flow and we ran it into a specially designed whole life policy and use that policy to help pay off debt? All right. So what I'm going to do is I'm going to go into my living expenses, even though we don't think that this is an expense, it's something coming out of our cash flow. So I'm going to say, I'm going to allocate $500 a month to my velocity banking policy or to my infinite banking specially designed policy. So now my net cash flow just decreased 866. Okay. So really all I'm doing is I'm taking $500 out of my velocity banking system and I'm going to put it into my infinite banking system. And I'm going to come up into this panel and I'm going to pick a policy that has $500 a month going into it. So here's what's going on. Every month, $500 is going into my whole life policy. And I'm going to just keep putting that in. That's my savings. I'm going to just keep doing that over and over and over. And every quarter, what we're going to do is take the maximum loan and throw that, just like we take our velocity banking chunk, throw that at our debts. We're going to take our maximum loan and throw that at our debts. Okay, so if anyone didn't follow that logic, let me know. I'm happy to talk about it again. But essentially, we're funding the policy. It's going to be growing uninterrupted compounding interest. We're going to leverage that cash value and throw it at the we're going to throw it at the policy or at the debts. So let's think about what did I show you earlier in the policy? We had a $10,000 policy. In this case, we have a 500 a month or 6,000 a year. When we're putting premium into the policy, we're building cash value. We're going to take a loan against that cash value. So now I have extra funds and I'm going to just throw that at the debt that's at the top of my list. It could be the personal credit card, could be the car. It's very similar to what we were doing with velocity banking, but we're just using a policy instead, right? So in velocity banking, we were putting our income into the HELOC, paying our expenses out, taking our net cash flow and leaving that in the HELOC and then taking chunks and throwing it at the debt. Same thing with the policy. We're putting $500 a month into the policy. So in a quarter, I may have put in 1,500. Maybe I can take out 1,100 and throw that 1,100 at the debt. Okay. So let's see what that did. So now in my payoff strategy, I can see the debt avalanche alone, the infinite banking alone, velocity banking alone, or what we call the debt plaster trifecta, which is all three of those at the same time. So imagine you're doing the avalanche, infinite banking, and velocity banking all at the same time. Now your debts are going to take a little bit longer to pay off because we slowed the velocity banking down to do the infinite banking, but we're building wealth. So we're giving up a little speed for some wealth building. So in 31 months, all of our debts are gone. We're going to take 7 months of taking that same debt payment and run that back into the policy to pay the policy loans off. So we have a debt cycle of 38 months. We added about 8 months to our debt pay down over the velocity banking. But here's the catch. At the end of 38 months, we have $1,265 of cash flow free that used to go to debt. We ended up with about 13,000 in cash value in our policy at month 38 and a death benefit of 128,000. So now we're in a little different position now that we're done with our debt. We have not only a line of credit, but we also have cash value in our policy. And so the next time we need to borrow money, we're not going to go to the bank. We're going to use our own system. We're going to use our velocity banking tools. We're going to use our infinite banking tools. And we're just going to keep building on this. We're just going to keep going and keep going and keep going. And we're just going to get ourselves into a better position where we have lines of credit and access to that. We're going to have cash value building and building in our policy. That's what we're trying to accomplish here is building wealth while getting out of debt and doing it quickly. So I know I just covered a lot. So I want to just pause and just see if there's any other questions. Brian and Mike, anything come up in Q&A that we need to address live?
Yeah, there was one. Where'd it go? So Chloe just asked, so I have a policy, would I still put 500 in and take out quarterly? So on the premium side, if you're doing a deposit every month, then yes, you still continue putting in the premium deposit into the policy as a, yeah.
Policies can be designed where you're doing annual premiums. So you may do it one time a year, you might do it quarterly. And so what we're saying is if you're doing monthly premium deposits, you could take a loan every month, but it's just a lot of work on you, and the insurance companies aren't really big fans of it either because they're not transactional. So the math doesn't change a whole lot if you just every month put your premium in and then once a quarter take your loan. It's a little bit easier on you. The insurance companies like it a little better. So it's just one of the ways we run the math. Now, if you want to drag this to say, well, I want to take monthly loans, or if you're funding your policy yearly, you can drag that over to yearly. So those are some different options that you can run.
Yeah, you can always change that mode of premium deposits, monthly, quarterly, semi-annually, or annually. I saw that question somewhere as well.
Yeah, and
Yeah.
someone just asked that question in the Q&A, but yeah, I mean, you can call up the insurance company and change from monthly to quarterly, annual to monthly. There's no guarantee it'll be exactly the same math. So if you're paying 1,000 per month and you go to annual, it might not be 12,000, it might be like $11,650. So it can be slightly different, but generally speaking, it's going to be the same.
Yep. Good questions. And then, some of the things that I oftentimes hear is, hey, this is great, to be able to do the avalanche, the infinite banking, velocity banking. There's money flying everywhere. How do I know what to do and when to do it? And so what I didn't show you is if I scroll down, we've got a table of numbers here. And I'm sure there's some people out in the audience that are probably my people, my spreadsheet people. I love spreadsheets. I love building spreadsheets. But a lot of people will look at this and go, holy smokes, what's Craig showing me? This is a lot of numbers. I'm not sure what to do. And so what we want to think about here is this is showing you kind of a month by month, what do you do? And so in month one, it's saying take 22,546 out of your HELOC, and we're then going to pay 2,551 and 88 cents to this personal credit card, pay it off. We're going to pay off the business credit card in full. We're going to pay off the personal loan in full. We're going to pay off the medical debt in full, and then we're going to take a chunk out of our car. Now, we're going to use our net income, if you will, because we have our income coming in here, our expenses going out, we have some interest being accrued. So we're going to be whittling this balance, this HELOC balance down with our net cash flow. But we're also going to be paying the debt payments, like the 85 to the car. I mean, that's still going to happen. And you see down here in month seven, and I just need to get my dates updated at the top, but this would be an instance where we're taking out $1,000 from the policy and we're adding that to the car loan, right? So we're going to accelerate the car loan that month with an extra $1,000 payment. And then we take nothing, we take nothing, and then we take 1,000. Then we take nothing, we take nothing, and then we take 1,000. So we're just going to keep doing this until we learn that, oh, there's another chunk that we're taking out of our velocity banking down here in month 31. We only need 11,781 because we're going to pay the rest of our debts off at that point. Then we're going to work on paying the policy loan back, and then we're all said and done. So there is a table of numbers for my table and spreadsheet type people. And matter of fact, if you want to, you can download this as a CSV and do other fancy fun things with it. And then there's people, like when I first showed Chris Naugle this, I could just see his eyes rolling to the back of his head because he's not a wall of numbers kind of person like I am. So we built this GPS down below, and I'm just going to go back to month one here. So the GPS is very simple. It just says, all right, you're going to take 22,546 from your VB tool, your HELOC. You're going to deposit this much into your HELOC. You're going to pay this many expenses out of your HELOC, and this is what's going to debt payments. And so you just kind of walk through, well, month two, I don't take any chunks out of my HELOC. I just pay my bills. Month three, and you just keep going. Month four, five, six. Once we get to seven, oh, we take a policy loan. So it'll just kind of give you that, more guided approach than looking at the wall of numbers. So whether you like wall of numbers or you like simple, we've got both of those for you to work from. All right, gents, any questions we should cover before we move on?
I've been answering the ones in the Q&A, so I got most of those.
Okay. All right. Well, let's move on to some other use cases. And for all of those that said they had some debt, if you haven't talked with our team yet, I would highly encourage you just to have that conversation. And if you feel like, well, I'm not sure if I have the cash flow yet, or you're just trying to figure out how velocity banking would work, we meet with folks and we say, well, it may be 6 months before you could start infinite banking, but we're going to look at your cash flow and figure out what does your specific situation look like and how do we get you in a better position next month, and then continue on from there. So
Yeah. Hey, Craig, before you move on,
yeah.
If someone already has Money Max, what would you suggest them to get the vault in addition to? I'm not that familiar with Money Max directly.
Yeah, and I mean, Money Max does some things that the Vault doesn't, and the Vault does some things that Money Max doesn't. So it really kind of depends on what you're trying to accomplish. But there's a world where they both can work together, but they also have some overlap. And I'd say if you're just working through some debt pay down strategies, the Vault is really good at that piece of it. So
Yeah, I mean, and having experienced something like Money Max before, what Money Max is doing is using different buckets of debt that you have that might have, free use on them, like credit cards, lines of credit, checking accounts, mortgage. And then what it does is it moves money from one bucket to another bucket constantly. And it does that to affect the interest that you're going to be charged total on all those different debts and reduce that. It's a lot of work for when I did it because you had to go in there every other day and move money from this account to this account or do a transfer, whatever it is. And so that it was a lot of work in that regard. If you have, and so this is my kind of experience, if you have a lot of debt, you have very little to no disposable income, and you don't have anything like you can't get a HELOC, you can't get any more kind of stuff like that, and you possibly can't get an infinite banking policy because you're cash strapped. Money Max can be a good vehicle because it can start to really get control of the debt and the interest. Um, so just kind of my input there.
Yeah. Yeah, appreciate that, Brian. And so the a couple things I'm going to touch on before we leave the debt piece, just because when people are playing with what ifs, and I've had conversations with folks where the tool, the vault itself is saying, hey, we think you should pay these debts off in this order. I did have in one of my strategy calls someone sharing, hey, I borrowed money from a family member, and look, when Thanksgiving comes around, they sit across the table staring me down. It's just uncomfortable. I just want to get that debt out of my life. And so there are some reasons why you may want to restructure your debts outside of what the vault is telling you to do. And so let's just say, for example, you had, this emergency credit card was actually a debt to your brother-in-law, and he's, threatening to break your kneecaps. So you may want to just drag that to the top of the list, and you'll see now there's a recommended order and there's a custom order. By doing the custom order, when you scroll down here, and I'm just going to shut some of these things off just to, show the simplistic view here. So basically what this is saying is, in some cases, the custom order may introduce more time and it may introduce more interest, but in this case, it didn't. It's, the interest cost is actually the same. Hey, that's no problem. You can certainly do that. It's a wash. But let's just say you start moving other things around where I want this medical debt paid first, and maybe I want my car loan up here. As you start restructuring the order, you might find that, oh, wow, I'm actually starting to add time to my debt, and I'm adding more cost in terms of interest cost to pay off all the debts. But just know there's you can structure this to fit it to however you want to operate. We're just simply trying to show you the best mathematical way, but if you need to structure those for other reasons, absolutely go ahead and do that. All right, so I'm going to shift over to some different use cases unless there's any other questions on debt or anybody has any
Yeah,
specific items.
Anthony has a good comment here because I know Anthony or Tony as he prefers not to be called, and he's used Money Max and found it really difficult to utilize. But his comment here says there's a point where you need or you may need to shut off velocity banking, and apparently Money Max doesn't like that because it's using that as a vehicle to reduce
Mhm.
things. But yeah, Money Max is hard to I don't say hard to customize, but it will make you do certain things you may not want to, and it's hard to make it not say to do that. I guess that's the best way to explain it. Whereas the vault, you can, as Craig just showed, you can definitely customize it and tell to do certain things.
Yeah, and the other thing that's interesting there is, and I'm not sure, in the case like when do you want to turn off velocity banking, but I've had some cases where even though we may have 45,000 available here, someone might say, well, actually, I've got $100 remaining in that's all that's available. I've used the 50 and now I want to use velocity banking for my debts. So you might say to yourself, well, I don't know if I can use velocity banking for my debts anymore because I only have $100 available, right? So maybe at that point, I just need to shut velocity banking off and don't think about it. But in reality, what we're doing here is we're recalculating, saying, well, you have 100 available. We're going to then run a different optimizer to say, all right, what you need to do is keep running your income into that velocity banking tool until you get 74.98. Then we're going to use that as our chunk size. So the tool is smart enough to know, and I'll actually show you if I activate this and I go down to the tool here, it's going to wait until month 14 before you can take a chunk. So what it's trying to figure out is when do you have enough built up to where you can actually start using chunks from your velocity banking. And so it's saying, well, by month 14, you should have enough to take a chunk of 74.98, throw that at the debts, then use your net income. So sometimes we don't have enough in our tool, our velocity banking tool, just to go get a chunk right away. May just have to wait, and that's okay. So just know that even if you're saying I need to shut velocity banking off, this thing will recalculate, say, well, there's not enough in my velocity banking to take a chunk size. I got to wait. I got to wait till I build it back up. So I've seen some cases where people operate negative cash flows, and sometimes it works, sometimes it doesn't, but it's really interesting. You just kind of run the numbers and see what happens. And Sabrina says, is velocity banking only for those using HELOC? No, I mean, in Sabrina, we're using a HELOC for this example, but we oftentimes will use HELOCs. You can use personal lines of credit. Christy Van does teach that you can use credit cards. It's a different strategy of how the money flows. But the two most common would be personal lines of credit and HELOCs.
Yep. I mean, even a more simplified version of it, I had someone do this yesterday. They borrowed from their 401k, like $50,000, paid off a bunch of debts, then
Mhm.
they pay back the 401k with their cash flow, and they take the cash that was going to the credit cards and the debts, and they're putting that into the 401k as well to pay it back faster. And so that's all they're doing is going from a very high interest environment, credit cards, to a low interest environment, the 401k loan. And they're paying that 401k loan off a lot faster, which means even less interest. But that's velocity banking in a nutshell. But yeah, there's lots of different buckets you can use for it or tools.
Yeah, and that brings up a good use case. Let's do this. So, and I know there's a lot of folks on here that do velocity banking and they're already going to know the answer to this, but I'm going to run through this anyway. It's kind of fun. Let's say that I had a mortgage with $305,000 of balance and my interest rate is 3.25. So I'm paying $2,257.67 a month in my payment. Do you think it makes sense for me to go get a HELOC? Let's say I get a HELOC at 7.25. Would it make sense to use this higher interest rate tool to pay off this lower interest rate mortgage? Who thinks it makes sense to do that? And so if you think it makes sense, put yes. If you don't, say no. And I just want to see. We have some yeses showing up. We have some yeses. All right. So we have a little
Importantly,
bit
what
of a
does the
mixed
vault say?
audience here. Yeah. So we have a no idea. Well, let's run through this because this is a really important point to keep in mind is this 3.25 the same kind of interest that this 7.25 is? Are they the same types of interest? Do they behave the same? And Anthony nailed it. Simple versus amortized. So they are not the same. And if you look at a mortgage, especially a newer mortgage, there's a huge amount of your payment going to interest in the first 7 to 10 years. So let's say out of this 2257, if it's a brand new mortgage, what if 60% of that is going to interest and the rest goes to principal? That's a lot going to interest. And so in a mortgage, there's huge amounts of volumes of interest being paid out at the beginning of the mortgage. Most people keep their house for less than 7 years. They move, they refinance. So the banks love it because they keep resetting that schedule. Now let's talk about the HELOC. The HELOC is what's called simple interest, which means every time I make a payment into that HELOC, say my income goes into that HELOC, 100% of that is reducing the principal, which then interest gets calculated on. So these are two completely different worlds. But let's see what happens if we use this higher interest rate tool to pay off a lower interest rate mortgage. So if I just pay the mortgage off naturally, it'll be done in 169 months. I'll pay $75,000 of interest. If I use this HELOC at 7.25, I'll pay the house off in 89 months and I'll pay 42,000 of interest. So this is just fun with math because we're taking a higher interest tool, but it's simple interest to chunk and get rid of an amortized mortgage at a lower interest rate. And we're saving time and we're saving money. This is the power of velocity banking. So anyway, hope you enjoyed that little math exercise, but it's always fun to show. All right, Mike, Brian, anything you want to add to that?
No, I mean it's interesting how when we go and do this kind of stuff and show these debt things, it sounds complicated. There's a lot of moving parts and pieces,
Mm.
but how easy is it to get into debt? It is super easy to get into debt, and it's very hard to get out of it. That's a strange thing for most people.
Yeah.
But what's the number one thing that makes it that way? It's your mindset, by the way. It's your money habits. It's not because it's actually hard. It's not because it's, easy. It's really not any of that kind of stuff. It's your mindset. We are taught as we go through life by family, corporate America, banks, employers, all that stuff, that debt is the way that we should live. And so they make it very easy to get debt, to get a mortgage, right? So it's weird. So like Craig, you mentioned before at the very beginning of your presentation is what is the surprising low number? It's the HELOCs. Okay. The mortgages are very high, but which one is detrimental to building wealth? The mortgage. Which one is a better financial tool? The HELOC. Which
Mm.
one's harder to get? The HELOC.
Yeah.
The one that's actually a benefit to you is very hard to get because of the banks. It's very strange that they do that. And so that's why being here and listening to what Craig and I are talking about and Mike are talking about, gaining that knowledge, that's the key thing that you need to make this stuff work for you, in my opinion.
Yeah.
It's very hard with the advertisers and keeping up with the Joneses and inflation not to be in debt, but you have to underspend your income. So Warren Buffett has a great quote, do not save what is left after spending, but spend what is left after saving. And no better place to put that savings than one of these policies.
Yeah. Yep, that's a really good point because there's so many things. Nelson Nash talked about the Parkinson's law, and that's where, it's got multiple facets, but the one that always sticks with me is how expenses rise to meet income. And think about every time through your life you moved jobs, maybe earned more, you got a raise. What happened after that? Well, you typically got a better car, you got the bigger house, you got the nicer clothes, you got the bigger vacations. And if we can just interrupt a couple of those cycles and start saving more into the policy to put it to work to have our own financing engines or to even have opportunity funds, that's what gets you. So,
Yeah,
um,
whenever I hear someone say, you only live once, it's usually followed by a very poor financial decision.
yeah, YOLO.
Yeah.
Yeah,
And
yeah,
another thing that came up on a call here this week was someone was talking about how they were doing fine, and then they had a huge issue that came up. I think it was like Frank said, house repair. This one was like a structural damage to a house. They had to go into debt to take care of it because what happens is we don't think about the events that are going to happen. And I say they are going to happen because they are going to happen. And so, but I've had other clients over the years that have had a policy. They're just using that as their kind of forced savings account. When that big issue comes up, they borrow from the policy, pay for that event, pay themselves back, but they don't feel that huge like cash crunch or that big financial hit because they already have the vehicle in place to take care of it. It's the same thing in real estate, by the way. So how do you have success in real estate when I'm talking about rental properties, by the way, today and then 10, 20 years down the road? How do you have success in real estate if you're going to be in it that long? Capital expenses. You've got to expect capital expenses. Roof is going to need to be replaced. Furnace is going to have to be replaced. The water heater is going to blow up. So when you have rental income, you take a certain percentage, 10 to 15%, and you set it aside for those big expenses. So when they do happen, it doesn't hurt you all that much. We should do that in our personal lives as well. And infinite banking for me is my way of forcing myself to make sure that I have that money set aside for when these life events do happen.
yep, yep. It's a great place to store our emergency funds because life happens. It certainly does.
Yeah.
So,
And I mean, some people, by the way, they have their 401k as that. They know that if something catastrophic happens, like, hey, oh my gosh, my car just blew up, you need to get a new one. They'll go and borrow from their 401k and then pay themselves back over time. I mean, so it can be more than one thing that does that for you. It's just if you don't have that in your life, I mean, I've talked to too many clients that have had something happen unexpectedly and it just nails them because they're not ready for that big expense.
yeah, and this brings up a really good point because you could use 401ks, you could margin your stock accounts. There's lots of different ways you can get to capital. We just happen to really prefer and like the specially designed whole life policies because of all the things that comes with it. So when we take loans, there's no structured repayment. We don't have to make a payment, unlike a 401k, they're going to take um, take it out of your paycheck. So, there's always control things we have to think about, and taking loans from the insurance company tax free, our policies grow tax free, the death benefits tax free. There's protections in some states from predators and creditors. So there's a lot of things that come along with why we use specially designed whole life policies to do the job that we're trying to do. And, so but there are other methods that you can use, like we mentioned with 401ks, with margining stock accounts. It's just they're not as efficient and come with all of the other benefits.
Yep.
But if you guys are okay, I want to kind of finish up with just talking about policy loans because I think it's an area that people struggle with. Like, why in the world would I take a policy loan for my policy to buy a car? It doesn't make any sense. Or in Brian's case, why would I take a policy loan to cover medical bills and then pay that back over time? That just sounds kind of weird. Why not just use a credit card? Why not? Of course, there's always the interest to talk, but let's kind of think about if we were, let's say we're going to go and spend, I don't know, 25,000 for a used car, maybe for our daughter, or what, she's going to buy her first car. And you may have a policy, and let's just say it's at 5.5, let's call it 6%. Let's say our policy loan is at 6%. What a lot of people don't realize is how does the interest work inside of these policies? And this is a really important thing to know, is when you take a policy loan, you're going to accrue interest on that policy. That interest is payable at your policy anniversary. You may not want to pay that loan interest, and if you don't want to, they'll just add it to the balance and you just keep going. So one of the things that we do in the vault is we say, how do you want to deal with the interest? Do you want to roll it to the balance or do you want to pay it annually? So you have some different options there on how you want to deal with that. But let's just run through some quick what ifs. Let's say I'm going to buy a car and we're going to structure this loan to where we're making 60 payments. So over 5 years, we're going to pay this 25,000 off. Now, that means we need to pay $480.85 every month back as a loan repayment to the policy. So the first thing I want to ask is, are we really paying 6% interest cost on that loan? Who thinks we're paying 6% interest cost on the loan? If you do, just put in 6%. So nobody thinks we're paying 6%. You're all getting gold stars for the day. What's happening is every time we make a $480.85 payment, that's going to reduce the principal, then the interest gets calculated and set to the side. So this is a simple interest loan. So if we just do this over 5 years, our effective interest rate is 2.98% because we paid a total of $3,723.71 on that 25,000. So we're not really paying 6%. And then the other thing to think about is, did our policy continue to grow while we borrowed this money? Does anybody know if our policy continued? Rebecca says yes. Robert says yes. Kevin's yes. Absolutely, it did. We're typically working with companies that when we take a loan, it's going to continue to grow. But let's show the math on it. But before I do that, I want to show you something real quickly here.
And I think you mentioned, Craig, about the loan rate. It's like a credit card will say there's simple interest, but it's not even comparable to a policy loan. A credit card simple interest loan is not the same as a policy loan at simple interest.
Right, right.
And I don't know of any other loans that calculate the way that infinite banking does. Is there any other kind of loan vehicles that calculate the same as infinite banking?
Not that I'm aware of, because even in a HELOC, it is simple interest where the payment reduces the principal. Then they take the interest and put it onto the balance and then keep moving. With a policy, the interest is set to the side, so it's not aggregated every month. So you're not compounding that interest over time.
So like if you pay $1,000 on a car loan, 300 goes to interest, 700 goes to principal. Same loan with a policy, pay $1,000, $1,000 goes to principal. That's the big difference right there. And so your money's working harder for you paying down principal with a policy loan versus other kinds of loans.
And with the HELOC, you have to make a monthly payment
of interest first. Yeah.
With a policy, you're in full control. Technically, you don't have to do it every month if you don't want to.
Yeah. Yeah. So then, what we do from a policy planning perspective is if we're going to take this 25,000, I went in and selected a policy, and let's just say I've got a family system with multiple policies. I'm going to pick a policy or multiple policies to service this $25,000 loan. So I select my policy, then I can go into my personal loan planning. And this is where, maybe I've got a daughter, her name is Minnie Doe. We're the Doe family. I'm Bucky Doe and my daughter's Minnie Doe. And Minnie could go get a loan from the bank. Let's say she would get it at 7%. So we're going to treat our family system the same way we're going to treat a bank. So I'm going to charge my daughter 7% for the cost of that money. Now, her payment back to the family system is going to be $562.50. So what we're going to end up doing is overpaying the policy loan because we can't put 562 in for the next 5 years. We're going to pay our policy loan off and still have money. So that ideally would go into the premium. But what we're showing down here is if Minnie Doe went off and did traditional financing, and this is showing the lost opportunity cost. She would spend 25,000 in principal, 4,701 in interest. So $29,000 just left our family system if we did traditional financing. This money's gone. It's at the dealership, it's at the bank, it's gone forever. So if we're putting our savings into the policy, what I want to know is yes, I have an interest cost, but I also have policy growth. So if I over this 5 years, let's say we put in $75,000 of premium, this is a brand new policy, by the way, so we haven't gotten over those efficiency points. Let's say that the policy grew 74,000. So I'm still a little bit down in the ins and outs, right? So I put in 75, I have 74 of growth. But what we're looking at is for every dollar of financing that we did in our system, and this includes the premiums, this includes the interest, we have a paid for car at the end of 5 years. Plus, we got 96 cents of every dollar back that we paid for that car. So, is it better to do this system or this system where we lost everything? It's gone. That 29,000 is gone. So, what we're talking about is by putting our premium dollars in there and building up capital, this is where our savings is going, and then leveraging it to go buy cars to fund opportunities. We're actually reducing that actual interest cost down significantly because maybe I lost 1,000 here, um, and I paid 3,000 of interest versus 4,700. So maybe it's a wash. But let me show you what happens if we go down a few years. So instead of starting my loan right away, let's say that we're now buying another car and it's now 2030. So we're a few years down the road. And why I'm jumping ahead in years is I want to show you what happens to the growth in the policy while we're taking the loan. So check this out. We put in 50,000 of premium over those 5 years, but we grew 64,000. We now get $1.25 back for every dollar we used for financing. How cool is that? So did we have to give up something to get to this point where we're actually multiplying the money even as we're using it? That's pretty cool. And this is why we always say this is a long range thinking. This is long-term thinking. We're re-engineering the way our minds and our money works is we're willing to give something up for the first couple years because I'm not going to get dollar for dollar out, but I will down the road. I'm going to start getting multiples of dollars back even when I'm using the money to go buy cars as opposed to just giving it to the bank and giving it to the dealership. So we're doing the math for you. You can see the economic benefit of paying the policies back. You can see the economic benefit of funding the policy, how it grows. It's just flat out one of the best systems between the policies and the first lien HELOC. Those two tools I think are game changers for people and their money. So with that, Mike and Brian, anything you want to add to this? I could probably talk for another 2 hours on this, but I know we're at time.
That's great,
No,
great
no, no,
stuff.
no, makes sense. And this is this is something that I think has been missing in the industry for quite some time.
Mhm.
Yeah,
So yeah,
it's life changing. This concept, it really is.
yeah, yep, yep. Yep, I gotta probably put the vault to use in my policy as well here soon.
Yeah, and so if there's any questions, I see Ben's asking about the affiliate program. So we do have an affiliate program. It's really geared towards other practitioners, financial educators. So Ben, I'm going to put my email in here. If you want to just reach out to me, we can connect and I can kind of share with you what that looks like. And Ben, I can kind of share with you. It doesn't, you don't necessarily have to be an agent. We do have some people who do tax strategies, because they're helping their people with debts. So it just really depends on what you're after, but I'll put my email in here and you can reach out to me and we can talk about it.
And then Sam has a question goes, how does the withdrawal of additional dividend credits happen? At what point does the interest involved in these illustrations pay the interest?
Well, as I was showing in that last example, the growth of the policy grew way more than the interest cost of me borrowing that 25,000. So you're eventually going to get to the point where the policy growth is way outpacing the interest cost of using the money, but we don't want to just keep stealing from our system. We want to, put the premiums in, we want to borrow and pay it back. But typically within, once you hit that efficiency point of that cash on cash, which can happen in year three, could happen in year four, that's where you're starting to get growth that's going to outpace a loan cost.
At
In the
what point
first
would you,
year, that's not necessarily going to happen. In the second year, probably not going to happen, but usually by three or four.
you mean the cash on cash is positive? Positive?
Yeah, typically once you get through those efficiency points, you're going to start to see where the growth of the policy is going to exceed the interest cost of using the money. And that's really what the vault is doing. You can kind of put your policy in there and kind of play around with different loan repayments and growth
Yeah.
and kind
And
of
Sam, for yours, your policy is cash on cash positive year four, and I think break even is year eight or nine, something like that. You're thinking maybe year eight. And then his question is, how much can I overpay in the loans? You can pay the entire loan back 100% if you want. Now, if your loan is $10,000, the question you're probably asking is, well, if I overpay the loan, can I pay it back at $13,000? The answer is typically is going to be no, but yet if there's room inside the policy where it can allow more to go in, then you can pay more back than what you borrowed. But we wouldn't know until that time. We have to run the numbers. But
Yeah, and this gets into, it gets a little confusing how it can work, but when we talk about overpaying a loan, if my loan is $10,500 but I want to put 14,000 back into my system, well, I can only pay the insurance company back the loan amount that I owe, right? What am I going to do with that remaining? If it will go in premium, that's where we want to put it. If you
yep.
have room in your premium, that's where we want to put it. And that's what Nelson Nash was teaching is we want to pay the same amount back into our system that you would pay a bank. And all of that overflow should go into premium, whether it goes in now or it goes in next year. It needs to go into premium to build more cash. And so he's got in, I think it's on page 52. Let me look real quick.
Yeah.
If you haven't picked up this book, this is kind of the Bible of infinite banking. But so check out page 51, and Nelson Nash walks through an equipment financing model where he funds the policy for 4 years. Then he takes money out to buy logging trucks, pays the policy back. All the overflow is going back into premium. And he just shows what happens if I buy one truck every 4 years. What if I buy two trucks or three trucks or four trucks? And he just keeps showing how the more financing you do, the more you're putting into the premium side. And at retirement at 65, I think he was looking at is how much more cash do you have? How much more cash value did you build? That's different than just borrowing and paying back the same amount you borrowed. He's borrowing and paying back extra. He's paying back the same amount that he would have paid a financing company. So what he does, he goes to the bank and says, "All right, if I'm going to buy a truck, how much are you going to charge me?" And then that's what he pays his system back. So,
Yep.
all right. Well, here we are a
Well,
little bit over.
yeah. And no, Sam, income does not equal premium. I mean, you can do that eventually, what's talking about, but it takes lots of policies and time. Let's put it that way.
Yeah.
Not very many people are going to reach that level.
Yeah. It is definitely an exercise in imagination, reason, logic, and prophecy. So,
Yeah.
but it's one thing you want to just think about. It's an amazing system. It's an amazing tool. What it's not is a get rich quick scheme. So anybody out there kind of pitching that, turn it off and run because it's a long range, long term. How do I keep more of my money? How do I quit giving my money away? That's what it's all about.
Yeah. And then one last question. Herminio says, can you explain the MEC limit and how much below the limit you should recommend? Is the annual MEC limit a reset or a continuation of the previous year? So the MEC limit it's an ongoing calculation, to be honest, and it's very complicated, but we build policies right up to the MEC limit, so right underneath them. So we don't really want to build it well below that. We want to make the policy as efficient as possible, which means right up to that limit, but not above it. And by the way, that is very different than what Nelson Nash would do in his day because policy structures back in his day were different than they are today. Now we can overfund them with the cash value very early on, whereas his were a little bit different. That's why he could put more into them. But and then as far as the MEC limit is an ongoing calculation. It's always changing, but it's an ongoing calculation. I don't know if I would say that it resets every year. Craig, I don't know if would you say that?
It's
Kind of.
they have this thing called whenever there's a material change, but there's some ambiguity to what that actually means. But dividends and how much premium we're putting in, the dividends, all of that stuff can impact the MEC room. And so the best thing to do is just we ask the insurance company what is the current amount we can put in, and then you know what it is that year. And it may change. One year you might be able to put in, an extra thousand, and the year after that, maybe you can put in 852. So
Yeah.
it's just a question we have to ask.
Yeah,
And some
just and
companies,
ask that question because you're going to want to put every extra cent you can into these things because they
yeah.
are that efficient. So you can check with the insurance company or your implementation agent.
Or Lafayette, you just log in and it tells you right there.
Yeah. Yeah, some companies will actually, when you go to make an extra payment, they'll say, "Well, you can only go up to this amount," and they clip you off because that's your MEC limit. But you definitely can find out what that is for your specific situation, and then we can make that you can make that happen. Like Mike said, you want to overfund it if you can.
Absolutely.
Yeah.
Cost basis, Sam, is just the amount of money that you put into the policy with regards to premiums. So premiums, PUAs, dump-ins, all that added together is just the amount that you put into the policy. So that's called your cost basis.
So if you put in 100,000, let's say that you get down the road and you've put in 100,000, your cash value is 150, and you say, "I want to surrender." What the IRS is going to say is, "Well, you put in 100, so we're going to give you your 100 back. You had 50 of growth. We're going to tax you on the 50 of growth." That's for a surrender. I want to walk away, take my toys home, and run.
Yep. Well, cool. Well, awesome. Appreciate everybody, all the questions, all the comments, all that kind of stuff. We are 10 minutes over, so we are going to call it a day here. But yeah, guys, I'm going to put in the chat box one more time the link for the 3-day event. Let me see where to go.
And Brian, do you also have a booking link in case people want to reach out and a strategy call with their team?
Yeah, so we want to put in the mentors one. That is definitely not it. You don't want to go to that website.
Yep, you don't want to go to that one.
Molina Healthcare or something like that. So here's the link right there as well to schedule a call with one of our mentors. Or if you want to reach out to, Mike or myself or Greg, just reach out to our team via email and let us know, and we'll get you their private links as well.
Yep.
And then what I'm going to put in the chat box really quick is my personal email address. So if you want to get one of our call links, just let me know and I'll send it on to you.
You want to throw the 3-day in there one more time?
Yeah, I'm trying to find out where it went.
I got it if you need it.
Yeah, Shauna had a good one in here. Where'd she put it? You can go and put it in there. That'd be good.
Yeah, Shauna's had all the fun icons and
I got
That's
a
a
boring
problem.
one.
Oh, there it is right there. I found it. Okay, there is a link for the 3-day event. Yeah. So definitely go ahead and grab your spot there. It's coming up fast. Jeez.
yeah.
I'm looking forward to the mobile home one. That's the one I want to watch so bad. I've dabbled in it, but I want to get back into that one, that strategy. That's
Affordable
what
housing. Yep.
What's that?
Affordable housing. It's always a
Yep.
hit.
Yeah, it used to be single family, but now it's I mean, even a single bedroom's not affordable.
Yeah.
Jeez. But, all right, everybody. Well, appreciate everybody. Thanks for all the comments, questions, and all that. And look forward to seeing you guys on the 3-day.
And
Take
don't
care, everyone.
forget, ask me anything at
Yep.
what is
Four
it, 4 Eastern?
4:30 Eastern,
4:30
1
Eastern.
Pacific. Yeah, just go look up Chris's YouTube channel to subscribe there, and you'll see it live streamed through there. I think he also does it through Facebook on his channel and some of our other channels as well. So, all right,
All right.
guys. See you all soon.
Thanks for joining.